Hello, I'm William, an entrepreneur, investor, and blogger. This content is for educational purposes only and should not be considered financial advice. My personal bias leans towards cash flow first, modest leverage, and disciplined entries. Every historic crash flashes the same 4 alarms. You don't need to guess dates. You need to recognize these buildups. In the next few minutes, I will show you these patterns and provide a 30-day plan to protect your capital. This plan will also position you to strike when others freeze. We will scan 4 significant market crashes, extract the 4 repeat patterns, and then apply them to today's market. We will conclude with a tight 30-day action plan for capital preservation and strategic positioning. Shocks do not cause collapses. They merely expose underlying fragilities. In the 1970s, inflation and widespread optimism primed the system for a fall. The oil embargo was not the cause, but merely the match that ignited existing vulnerabilities. The lesson here is to diagnose balance sheet strength, supply chain dependence, and policy sensitivity well before any spark appears. Japan's asset bubble demonstrated how prices can drift far from fundamentals for years. This unsustainable trend continues until it simply cannot anymore. The critical lesson is to rigorously test valuation against true cash flows, earnings quality, and replacement cost. Price often tells a story, but value is always rooted in mathematics. Excessive leverage transforms minor dips into catastrophic drawdowns. During the dot-com and telecom bubbles, debt and margin fueled an unsustainable euphoria. This same leverage then forced widespread liquidations when the market turned. It is crucial to understand your debt maturities, covenants, and interest rate sensitivity. The 2008 housing crisis exemplified a rapid confidence break following a period of euphoria. When belief cracks, capital exits quickly and through narrow channels. The lesson from this period is to closely watch market positioning and overall liquidity. Let's assess where we stand today. We observe elevated pockets of valuation in certain sectors. There is also high corporate and consumer debt across the economy. Market leadership remains highly concentrated, and policy decisions alongside geopolitical events act as significant wildcards. The 4 alarms are not all blaring simultaneously, but several are certainly blinking. Narratives around AI, electric vehicles, and certain crypto names are transformative. However, cash flows must eventually validate their current prices. It is essential to separate secular winners from purely speculative multiples. First, hold a robust emergency reserve. Second, actively reduce any high-interest liabilities you may carry. Third, insist on strong cash flow coverage for your investments. For properties, ensure a debt service coverage ratio of at least 1.2 on conservative rents. For equities, demand interest coverage greater than 3 times. Size your positions prudently so that a single bad quarter does not force you into a distressed sale. Consider a barbell portfolio strategy. On one side, hold durable, cash-flowing assets. On the other, allocate to selective, high-quality growth opportunities. Alternatively, adopt a core satellite approach. Maintain a low-cost core exposure with targeted satellites in verified areas of advantage. Stop trying to guess exact market dates. Instead, use a staged entry strategy. Consider deploying 1/3 of your capital now, another third on a 10 to 15% market pullback, and the final third upon technical confirmation or improving credit spreads. Let the markets effectively pay you to add to your positions. Monitor key indicators for regime shifts. Watch the volatility index, high-yield spreads for credit stress, and margin debt for forced selling risk. Pay attention to the yield curve as a growth signal, market breadth for narrow versus broad rallies, and overall liquidity measures. When 3 or more of these indicators deteriorate concurrently, it is time to raise your defenses. Week 1. Conduct a thorough audit of your personal portfolio and property leverage. Map out all debt maturities and potential rate resets. Understand your exposure. Week 2. Re-underwrite your top holdings using sober, conservative multiples. Be prepared to drop anything that requires perfection to justify its current valuation. Week 3. Build or restore your cash buffer to a comfortable level. Set clear, stage buy levels for future investments and establish firm stop-loss or position limits. Week 4. Diversify your catalysts by adding uncorrelated cash-flowing assets. Create a detailed watch list of high-quality names and properties to acquire only at preset yields or multiples. Winners do not predict the exact spark that ignites a crisis. Instead, they meticulously prepare for underlying fragility. They keep their powder dry, are ready to buy quality assets under stress, and compound their wealth calmly over time. If you would like my one-page crash playbook checklist, please comment Playbook and subscribe. I'm William. Build cash flow, control risk, and let time compound your success.